Yeah. Okay. So I'm going to talk about India's UPI based on some recent research that I've done. So let's get right to it. So for this audience, I don't need to motivate much, right? 1.4 billion people around the world don't have a bank account. This is not just a developing economy issue. Even in the US, the FDIC, where I was on deputation for 2 years, conducts a biannual survey of the unbanked, and they find the estimates in the US, depending on which year you look, the unbanked is in the order of about 5%, and underbanked is in the order of 16%. So this is a problem worldwide, not just for developing economies. Having a bank account alone is not sufficient for financial inclusion. For me, real financial inclusion is, do you get access to formal credit? And so even if you have a bank account, you may not have access to formal credit because you don't have a credit file or you have thin credit files. And so this is where the promise of fintech comes in. In research that I've done, we find that digital footprints, even a shallow digital footprint, right? And so what do I mean by shallow digital footprint? I'm not using your WhatsApp or social media accounts, but simply stuff from accessing, the website. And so, 10 variables. So Marion Bertrand has a paper showing having an iPhone, puts at the top of your tile in someone else. Simply, how did you get there? Do you have an iPhone? Did you type in the address? Did you click on shopping lists? Did your email bounce? What type of the day did you shop? 10 variables. They have as much explanatory power as your credit bureau score. So this gives you hope that people who don't have credit bureau score, we can still give them credit using alternate sort of credit scoring mechanisms. However, the evidence on this, at least in the US, of fintech sort of delivering has been relatively scarce. So part of the issue, of course, is how do you generate these digital footprints in the first place? And that's where we come in, that if you publicly provide a digital infrastructure, will that help sort of fix some of these issues? And so we studied India's UPI, which is a very ambitious digital payment structure, maybe one of the most ambitious in the world. So let me explain what it is. And so basically, the government is publicly funded digital rails. And anyone can put an app on it. It can be Google Pay, it can be Venmo, and all of these will talk to each other. It's interoperable, right? And so it doesn't matter who I have a bank account with, what app I'm using or you're using, I can still transfer money to you. So compare this to the US, where I need to transfer money to you. I have Venmo, you have PayPal. We look at each other and then write a check, right? So here, the interoperability is the key. So what does that mean? So think of a roadside vendor selling masala tea, right? So this is Sharda Masala Chai Wala, pushing a cart. So I go to buy masala tea, I pay $1. So I can use any mobile app I want, any bank account, and I say pay $1 to Sharda Masala Chai Wala in ICICI account. This is the account. It gets verified by UPI. They check, yeah, she actually has the account number. Then it goes to my bank. Yeah, I have $1. It'll get debited. It'll get credited to account, and it will verify this in seconds before I can take a sip from my cup of tea. This is done. And so, so what this does is you can do it any time of the day. You can use any account, and it's interoperable. We can do cross-platform transactions. Importantly, it generates a zero-cost, real-time, digitally verifiable financial history. And this is a game changer, right? And so what happens is Sharda Masala Chai Wali was earlier selling chai and getting cash. No one would lend to her. All she had was a broken down cart and some cash. But hey, she makes the world's best tea. She sells a lot of chai, and she sells, let's say, $1,000 of tea. And you can now see that digital trail. So a bank or fintech can look at it and say, hey, she's selling $1,000. I can make a loan of $200, right? And so we have cash flow based lending based on this digital trail. And so this is what is called an open payment system, right? Because I can pay to anyone freely. And the UPI then gives the basis for what we might call open banking, where who owns the data? In India, the customer owns the data. So unlike China, right, where Alipay will own everything, it's a monopoly. Something happens to them or they don't want to give it to you, you're stuck. Here, you can be with a tiny app, a tiny bank, it doesn't matter, right? And you can potentially share your data with anyone that you want. And so UPI grew phenomenally. You can see this. And what you see is with that growth in UPI, look at the growth in credit. It's just phenomenal. And this is so strong, it doesn't matter what you throw at it. This result will hold. And it holds everywhere for all segments of the economy, prime, subprime, importantly for financial inclusion for people who never have had access to credit before. We have data from the credit bureau. We know if you had access to formal credit. And so we can see that. But the important thing here is if when you disaggregate it, now a rising tide lifts all ships. Everyone is getting more credit. Both banks and fintechs are giving it. But from the point of view of financial inclusion, where is this money coming from? The risky loans, people who have never got credit before, this is being driven by fintech, not by banks. These are small ticket loans. The average ticket size is 18,000 given by a fintech. For a bank, it's 9 or 10 times of this. It makes sense. Banks don't want to do risky business. Transaction costs are too high. Fintechs are the entrance. They're willing to be fast, quick, and make tons of these loans, right? And so they're catering to very different segments. The other thing is we can look at the previously unbanked people. So India has a scheme of Jan Dhan Yojana or JDY. So a lot of India didn't have accounts. This is similar, as I said, to what FDIC finds in the US. And the two main reasons that we find in the survey at the FDIC is high transaction costs, poor documentation. This was fixed in India by announcement saying, hey, banks, you need to open accounts for all of these guys. And one, no transaction fees. Two, you do it, if you don't have documentation, open it and in 6 months regularize it. As a result, 99% of India is now banked. And what we find is for these JDY areas, once UPI is introduced, you actually see a surge in credit. Who is giving the credit? Again, it is coming from the fintechs, right? And so financial inclusion is happening in terms of credit access, primarily driven by fintech. Now, you might ask that, you're giving all this money, what about default rates? And obviously, if you give riskier loans, the default rates are going to be higher. But that's not the right benchmark. You need to control for risk and see if I lend under the old technology and the new technology, are there differences in default rate? We do that and we find no differences in default rates, right? Which suggests that you're expanding credit. You now have more financial inclusion thanks to UPI driven by fintech, but not a corresponding increase in default rates.
Thanks, Manju. Right on time, I will say. Okay, so I would like to switch this into more of a conversation now, and I'm going to come back to Manju in a second. But I'd like to go to Luke, who's the Chief Product and Innovation Officer at Onafriq. Maybe you can start with a bit of what you guys do, and then a bit of how you've been building this cross-border payment system. Manju and I are talking about these within country, within border payment systems, but clearly as we make bigger regional trade agreements, the Africa Free Trade Agreement, for example, that might come wishful thinking. But, how have you built that business and what do you think are the big bottlenecks for that?
Sounds good. Glad to be here. So Onafriq is a infrastructure company. You're talking about building rails and kind of think about bridging rails. And so what we do is we're in about 40 African countries and we connect to mobile network operators, mPesa being one of those, and banks and fintechs and other wallet providers. And we share this network out to the world to enable payments. We like to say making borders matter less, right? And we think about three things. One of those is just what we call messaging. So I'm a recovering engineer. And you think APIs, just one API that you can use to pay everybody. That's sort of the nirvana, right? And then there is, and that might even be the easy part. Next layer is compliance. So we're talking about 40 countries changing regulation, staying on top of that, and helping companies not worry about that. That's important because you want to make a payment, especially when you go to bigger volumes of payments, when you go to business type, you want it to be above board as much as possible. And so we spend a lot of time trying to make sure that that layer is taken care of. Again, but complicated, but perhaps the most complicated layer is the third one. It's settlement. Everyone talks about instant payments these days. You send a payment here, it will be an mPesa in no time. But so getting paid and getting settled are two different things. And the getting settled part is where essentially where the money is made. And that part is complicated for a few different reasons. So I was thinking about perhaps some insights that I'd share today. If I asked, what's the priciest part of a remittance? I don't know what folks would say. It is actually, sorry? Currency? The foreign exchange. So yes, it's converting currencies. So, paying into these networks, mobile payment networks, 1.5%, maybe 2%. The rest of it is going to be FX. And if we think about that, therefore, building rails is one thing, but if we don't fix the FX part, then these rails don't get used. So part of the reason prices still remain high is because of that part. The second insight is that across our network, and not just across Africa, about $1 in $5 that are moving into African countries are moving from another African country. So we think about remittances as into Africa, but about 20% is in between Africa. So one of the things we do is take mobile payment networks cross-border, right? So moving money from Uganda to Kenya to Rwanda and so on across all these different mobile payment networks, that interoperability is useful and good, but that $1 costs more than any of the other $4 as well. So it's pricier than the others for a number of reasons, FX being one of those. The fact that sometimes the correspondent bank is in New York, right? Moving money across to African countries. And there are a lot of things there that make it complicated. But again, that $1 is pricier. And it perhaps might be the most impactful because it's 20% of the payment flows. I'll say the last thing would be that if we think about what actually happens at the last mile today, about 90% of the payments are still offline. And that means cash and also USSD. So, because you don't need a network, you don't need a mobile internet to make that work, a lot of the systems that are still being built today in Africa are still either cash or USSD. And that means that's what we should design for and build for. When mobile internet has penetrated Africa, it's about, I don't know, by different, 30% maybe, and so on. People have access, but usage is only about 20%. So there's still a huge gap between the mobile internet usage and access. And so a lot of the payments still happen offline, which brings us back to, therefore, we spend a lot of time thinking about settlement. You can bring it in digitally, but someone's got to have the cash to pay out. A lot of that is funded by foreign, by dollars, and therefore it's pricier. Therefore FX comes into play. It's pricier to get it funded locally, but at least locally there's no FX. But the fact that foreign exchange is part of the puzzle drives cost up.
Thanks so much, Luke. I'm going to come back to you in a minute. So just don't put the mic down so fast. Let me switch to Paul and ask him to talk a bit about, you've done a lot of work on cash transfers with GiveDirectly, UBI, which I take no responsibility for whatsoever. We've heard about some of those results already from Chris. So more than results, it'd be nice if you took a step back and talked a bit about what do we learn about product design, maybe? What do we learn that's sort of applicable to the private sector side of finance a little.
Great. I actually wanted to start, if I may, just by taking an even bigger step back and share one sort of even broader reflection on the research that we've done at GiveDirectly, because it relates, I think, to themes that have been recurring throughout the day about, do we have too little theory, too little macro, too little finance, sort of too little different, too much RCT, all this stuff in development. And I sort of have a fairly optimistic view on all of this stuff in the sense that I do think that it would be good to have more of many of those things. I think that as long as we stay focused on big problems, we'll end up doing it. And that's very much been my own personal experience. Probably the most academically successful paper, and speaking especially to young people in the room, I think the most academically successful paper I've written was one that Michael mentioned in the previous session, talking about the paper with Ted and others on the general equilibrium impacts of cash transfers. And that paper came about because we were, trying to raise money at GiveDirectly, and a lot of people were reasonably asking, it's great that you know what the impacts are on the people who get it, but what about the impacts on the people who don't? And we sort of said, well, that's fair. And so we better go and do something about it. And that led to this project, which ended up being sort of, both very important for GiveDirectly, but also academically, one of the more ambitious I've been a part of. And that's led to other things that are much more technical. So for example, we used estimators in that paper that really had no sort of proper microeconometric foundation. And so I started working with a grad student of mine to sort of prove the limit properties of some of these things and figure out which estimators we should have been using. And so we're revising that paper now for a good journal. And so, I think that if you start by asking sort of relevant real world problems, you will sometimes end up having to do some things that look more like spreadsheet work and aren't going to get published in a journal. But in my experience, most of the things we care about in the real world also require like really interesting economics to solve. And there will be bits and pieces of them that will end up in good journals and also require you to sort of branch out and do something that you didn't think you would be doing. I don't think of myself as a macro economist. I ended up writing this paper on sort of macroeconomic multipliers, right? I'm not an econometrician by any means, and I'm working with econometricians. So I think that sort of focus, that problem orientation really is a great driver to sort of bring us back to these tools. Like if we believe that they're necessary for addressing important problems in the real world, we'll naturally come to them by starting from those problems. And, yeah. Okay, so on social protection specifically, it's actually very interesting because if you think about what we can learn from research on social protection for product design, it's sort of a funny thing in a way because social protection, and I think especially sort of philanthropically driven social protection, if you will, the revenue incentives to actually think about heterogeneity, product design, and so forth are not so strong. If you identify a 20% segment of the market that would benefit from a better financial product, that's a big opportunity. If I identify 20% of social protection recipients who would benefit from a different transfer design, I mean, they're going to take it anyway, right? Because like, why look a gift horse in the mouth? And so it's a much less direct mapping from that to sort of, I'm going to persuade somebody to increase funding for what we do. And I think that's why if you look out at the world today and look at the way social protection looks, it by and large looks very undifferentiated, right? Most people get the same transfer design. And for most people, what that design is sort of a stream of small payments, maybe monthly or bi-monthly. And so that can be helpful in some ways, but it also does not address a lot of things that we know are financially challenging about the lives of people living in poverty. The challenges of getting together a large lump of capital to be able to do something, the challenges of seasonality of your income or your expenses, and some of the behavioral issues related to planning and sort of making sure you make decisions that you later feel good about. So we have done some things on those at GiveDirectly, but I think it is very much suo moto as opposed to market driven, right? That's an important point to recognize. What we've been doing simple things like in Kenya, for example, running experiments where we ask people if you could structure a given amount of money and transfer in any way that you would like, how would you do that? And we get what to me have been some pretty striking results. So you get that in Kenya, 98% of people would rather get the money in 1 or in 2 tranches than in 6 or in 12 or some larger number of small payments. When we've done focus groups across other countries in sub-Saharan Africa, we get pretty similar numbers in the 60 to 80% range. Essentially, nobody who wants a structure that looks like what social protection typically looks like. And when you talk to people about the reasons for those preferences, I think to me they're sort of intuitive and illuminating. You have people who will say, I want to do everything at once so that I can economize on transport costs. So there's some fixed costs somewhere else in the economy that you want to optimize with respect to. People who say they want 2 tranches, there's sort of a learning motive for it. They say, it'll give me time to evaluate profit from the first venture and then advise on next action steps with the next. Reasons that people don't want the streams of small payments will, I think, be familiar to many of you in this room. It will be hard to save to do the project. The money might be squandered. by me, right? There's too little to solve a big case, and keeping money is tricky and dangerous. So to all the points we've been hearing about access to reliable savings vehicles and so forth. So point number one, there's definitely a very strong demand for lumpiness, right? Point number two is that interestingly, there's also some degree of demand for deferral in the sense of getting money a little bit later than the earliest date on which you could get it. About 25% of people in Kenya, actually between 50 and 100% of people in other countries. And there we see people give us a mix of stated reasons. Some of them look like seasonality. Some of them look like planning, sort of having time to consult with family members or think about what you want to do with the money. But things like I'd like to have time, or I'll have time after the harvest to do the big thing that I want to do. And so it would be good to have the money arrive then. Or after the harvest, my neighbors will have a lot of money to spend. And so it would be good to have the money arrive then. And so forth. So again, second point, interesting timing preferences that are not what would pop out of standard models or what we would think about as economists. And then third point, substantial demand for payments that are state contingent. Social protection transfers, although they're called social protection, tend to be fairly state non-contingent, right? They're fixed amounts. We set up a pilot in Kenya where people had the opportunity to allocate money between those fixed payments and essentially purchasing units of a commercial index insurance product, right, that a local commercial provider gave. And about 60% of people wanted to allocate at least some of their money to the state contingent payments. And for those of you who work in insurance, you probably know better than I do. I think it's, uptake of those things has been very, very challenging. And so that's a very big number, right, to get 60% of people interested in those things. So again, sort of demand for state contingency. Backing away from all these things and then returning to your question, Tavneet, like what are the implications for private sector actors? I do think that in many ways, like we're following and not leading, right? So for all these things I just described to you, if you think about financial product design, are probably no great surprise to you. If you are at a fintech or a financial services company, I think one opportunity that I might highlight, which really relates to that last point about insurance uptake, is distribution, right? So in addition to getting this much higher uptake rate than you would typically see, our acquisition costs, when we layered insurance into this existing cash transfer program, were only about 1/4 of what our insurance providers' acquisition costs would typically be. And since acquisition cost really is often one of the barriers to getting penetration right at the bottom of the pyramid, I think that's exciting. So I think that's an area that you could look at. And then the second thing I'd say is that there are many firms that don't think of themselves as being financial firms, but that are engaged in regular financial transactions or payments, right, with employees rather, or suppliers. And so interestingly, at the same time as we were doing this research showing that people have a strong demand for lumpy transfer structures, there were other people running experiments with firms in Kenya and Malawi in which they showed that employees and suppliers also are willing to give up some money in order to defer a payment so they can get more at once and more at a time that works better for them. So sort of very similar demand structures to what we were seeing. But in those cases, it's creating stakeholder value for other people at the firm. And so it's potentially a commercial opportunity as well. So those 2 points, I think there's a distribution opportunity for fintech companies when we think about how finance and social protection can work together. And then also for firms that don't think of themselves as financial, still potentially an opportunity to play a meaningful role in people's financial lives.
Great, thanks, Paul. I think that relates nicely to sort of the rails trains analogy I was making. I feel like there's not enough different types of products around, even amongst the fintechs, right? That would customize your, lump sum amounts, timing, et cetera, which we seem to be able to do very easily in this part of the world. So I'd like to go back to Manju and just ask her, you kind of talked a lot about how the fintechs are stepping in on UPI to provide this. Do you have some sense of both kind of, are they providing a heterogeneous range of products? Like what's making them successful? Oh, first of all, are they successful? I was assuming yes from your talk, but maybe you could say more there. And if they are, kind of what are the things they're doing to get that success? Because we've seen a lot less of that in Africa. It just seems like there's a popular one that does one type of loan and then everybody copies exactly the same structure of loan, the same timing, the same everything, as opposed to thinks about customizing products to people, which is how we think of most of the consumer world.
So I think the way it works in India is, once I have UPI and once the customer can share their data, they can apply to multiple fintechs and multiple banks and push of a button. Each one can come back saying, this is the amount, this is the interest rate. and then I can pay. And so this is done very quickly, the verifiability and everything else. And so these are really just regular consumer loans, right? And so if you think about how do we make private markets work for served, right? And so I'm not talking, this is absent any government intervention. The only government intervention is that the digital rails have been provided and they're at zero cost. But now all these private institutions are taking advantage of it, and now markets are working for these people, right? In terms of regular consumers, which is massive. I mean, you think about it, that is just simply massive. And now it's true, fintech started at about zero, so you're going to see big growth. But if you look at the absolute amounts of how much credit banks are making to people who never got credit as compared to fintech, fintech is not the same level of banks, right? So that's what we're seeing. Now, why is that happening? Clearly, reduced transaction costs, right? The public sort of infrastructure. The other thing fintechs, I think, have an advantage of is speed, willingness to take risk, and willingness to use alternate sort of credit scoring mechanisms that banks are not, right? So when I talk to banks, when I did my digital footprint paper and I used to go to many fintech conferences, people from banks would come up and tell me, we used to try this, but then basically the examiners would say, how can you abandon time-tested models and based on is your email bouncing or do you have an iPhone? Give a loan, right? And they would get into trouble. But fintechs are willing to do this, and banks recognize this, right? And so I'm going to diverge a little bit, but it's relevant. So if you look in the US, banks recognize this threat of fintech. And so banks, VC, so this is another paper we're working on. Banks, VC investments have now moved to the fintech area, right? And so they move, there's a lot of patents, but importantly, we thought you would invest and you'll acquire. No, you invest and then you collaborate. You never acquire. Why? If you acquire, they become bank. You lose the innovativeness. You lose the ability to do all of these things, right? And so I think that's what we're saying, that fintechs can just be flexible in consumer loans in a way that banks can perhaps not.
Yeah, maybe they're too big or too, I don't know what the right word is. Great, thanks Manju for that. I'm going to cycle back to Luke and ask him the question, Paul's wish list question, which was, much as you're doing cross-border payments and a lot of that, are they things you wish you had known either when you started or now that you think researchers could help with? And if so, what are the sorts of questions that you think you would love answers to?
Thanks, Paul.
I flew out here for them. Wanted to hear you.
So when I met Paul, I made the delightful mistake of starting a payments company in Africa, Bionic, which was making payments into the same networks we're talking about across East Africa, mainly for development payments, and eventually the whole spiel of payments. And then we got acquired by Onafriq, which is why I'm with Onafriq. But I remember some of the things that we thought going in were that, maybe taking a step back, I used to work with Grameen Foundation, so we had been doing payments at the last mile, and we had this is people aren't able to pay the fees, right? And where you have small amounts of payments, the fees tend to be higher and so on. And so we said, well, we can help, mobile money can help there. Let's build a platform that does it. Eventually, the thing that took off was verification. Being able to just know that you're paying the right person. It wasn't so much that you were paying, the networks were there, but just knowing that you were paying the right person and therefore it's getting to the right place was a thing we put in there, and that was one of the selling points. So I think it's a lot of the research that is being done that teases out the why behind some things that seem obvious is useful, and companies, startups may not have the muscle, the time, the funding to do that sort of research. And so if we, that's one of the things that what are the things today that we've assumed about payments that when you go and really ask the users across a different wide enough geography are not the case, and how does that feed back into private companies in the industry? I think the fraud is one, for example, that's always a concern. And coming to your question, the question you asked her about fintechs and why they're not perhaps innovating. When you think about a place where I'd say the thing that stops us serving fintechs a lot of times is they don't have the right regulation. They don't meet that piece, and we're either going to have to take that on, or we're going to change the regulator. And so figuring out how we can create the same sort of UPI layer that makes it easy for folks to try a bunch of things, but across a number of different geographies. How do we do this in a place that is 50 countries? I think those are some of the things that
56 countries with 56 regulators who do 56 different things. Great. Maybe I think related to this is sort of, as you work on cross-border, Luke, that currency FX risk you talk about, have you thought about the role financial tools can play in that? And do you actually orchestrate that, do that, and a piece of that? Or how do you think about that? Because that's got to be a large part of the cost, as you said. And so have you been able to bring that cost down, and how are you thinking about that piece? Because as we do more cross-border, if you want the 56 regulators to talk to each other, there's still currencies there.
No, currency is a big one. And you even have cases where you have the same currency, ZAF or ZOF, across different countries, but it's not really the same currency. It's the same currency on paper, but you still have it. So it's things like that that could help if we really had uniform currencies, if we really had fixed or pegged currencies. Some people don't like that, but I think that helps because then it's predictable. Currency, it's the unpredictability that that drives up the cost. Because when someone's making a payment, you're gonna quote a rate, but that's not the time you're gonna settle. So you're gonna settle at a different rate, and so you're padding. Everyone along the way is padding, and that becomes a problem. Some definitely data helps, and so we're finding ourselves building out a whole AI-powered system around predicting currencies better. I want to bet a lot of people are doing the same, because it becomes part of your kind of secret sauce. If there's a way to have that be open or be shared, then that would help. The other thing, of course, is being able to settle much faster. So if you can reduce the time between when you quote and when you settle, then the risk is reduced, and then you don't have to pad as much. So we're playing around with those. Some of the new, I don't really want to talk about stablecoins, but some of that helps because it can reduce the time between when you quote and when you settle. When I get to the point that we can almost quote and settle in real time, and then you might as well have no FX spread on that.
Great. Awesome. Let me do one more question with Paul, just to kind of wrap up since I asked Luke that question, and then maybe we'll have some time for questions from the audience. I'm just looking around. Just signal me if you have some, otherwise we'll keep this conversation going. Okay, great. So Paul, briefly, you got to ask Luke your wish list question, which is what would you like to have known? Similarly, you've worked at GD to embed research into the organization. Any advice you have for organizations trying to do that, or how to link into, how to create a vehicle to have that happen more, would be great.
Great. Yeah, and just if I may, two quick riffs on things that others have said. So I think that some interesting and important research questions that to me sort of come up in hearing Manju and Luke speak. One is the question of sort of the political economy of interoperability, why we have it in some countries and don't in others. And so a great task, I think, for political economy would be able to say, here are some countries where we don't and probably won't for a long time because Visa and MasterCard are too entrenched. Jacob, you and I were just talking about this, right? Those guys are going to lobby like hell if we try to come in with a switch. Here are some others where we already have it, and here are some that are in this sort of like tippable gray area, and here's what the coalition building would need to look like to get interoperability, right? Like, I think that would be, maybe some of you are doing that. That would be very cool. And then the second on FX is like, yeah, to me, that, I mean, having also kind of built a remittance company on top of some of the earlier stuff we did, like this question of why the sort of the markets are so opaque and illiquid is just like a big puzzle. So I would love to have like a good explanation of that. Would be great.
Yeah, and just benchmark on that. I don't know why there aren't a million hedging tools for it either.
Great. But yeah, so your question specifically was about embedding research inside organizations. So, you know, and sort of are there lessons for people who might want to do those elsewhere, including at firms? And so I would say sort of no and yes. The no is that having started like a couple of fintechs as well as an NGO, GiveDirectly, I think there are some, you know, fundamental differences in the challenges we faced and the role that research play in those. At GiveDirectly, I think research was existential. We, you know, started doing this thing that everybody in our target market thought was crazy. And we believed from the start that if there was not research demonstrating that it had better impacts than they thought it was going to have, nobody was going to buy it. And you know, I don't think there's any way we get as far as we have got today, which is about $1 billion delivered, without having produced a lot of that research along the way. So you know, who knows what the counterfactual history of the world looks like, but I think that's inarguable. You know, whereas at the remittance company, you know, somebody who's deciding whether or not to use this is not asking like, hey, is there a good RCT on the impacts that remittances have on my family back home? It's like, you know, what's the price compared to the competitors? How easy is the app to use? These kinds of things and so forth. And so functionally, I think what that means is that at your remittance company, it's, you know, you are going to be doing learning and research in a sense, but it's more likely that it's sitting with your, you know, regional head of marketing and they're doing pricing experiments or things like that. And you're thinking about how to embed it into the culture that way, as opposed to necessarily having a sort of separate functional unit that is sort of research as it is. So, but that having been said, I think two observations from the time at GiveDirectly that might still be useful. One is if you are having that separate functional unit, it's kind of obviously going to be a cost center and not a profit center. And we, you know, struggled with the usual things that one does in that regard. You know, we had sort of people, you know, systems, you have to be clear about whose budget it's going to hit and what incentives that creates within the organization. And we did a bad job of that initially. And so we had people writing contracts that had, you know, implied that research was going to do a lot of work, and then research coming to us and complaining they didn't have enough budget and so forth. So, you know, it's kind of the sort of rookie entrepreneur mistakes. But I think there's getting that part right is certainly very important. And then on the positive side, while we've done a lot of research at GiveDirectly, I think we're at about 25 studies in counting. We have never had a lot of PhDs. I think we've had maybe one person with a PhD on our team. It has almost all been sort of being able to talk to outside researchers and collaborate well with outside researchers. The study with Ted we mentioned before, and some other students and co-authors, like working now on setting up stuff in Malawi with Dean and with Tommaso, who's here. And like that opportunity to tap into outside talent, really some of the smartest people in the world thinking about these issues, has really, really been great for us, right? And so, you know, there are like frictions in those relationships to navigate, and we will have people come to us and pitch us research ideas that are like clearly not in the organization's best interests, right? Things like why don't we see what the impact is on vote share for the incumbent? We're like, you know, that's like kind of mostly downside from our point of view. It's just like there is like incredible talent in this room, and I have sat on both sides of the relationship, and I do think there's enormous value for the people that are doing stuff in the world to make the effort to get past the communication frictions and to engage with researchers.
Great, thanks, Paul. I think Manju wants to jump in very quickly, so I'm going to give her 1 second, and then I have seen many hands, so I'm going to try and go to the audience.
So I just wanted to speak on, you know, the political economy of payments, I think is really important. And point for that, I think if you look at, you know, there's the lobbyists, and you mentioned MasterCard and Visa, I would definitely put banks into it. So when UPI was first introduced in India, it's not clear. The banks were worried because they were afraid that fintechs would eat their lunch. But what has happened now is time has just grown. And so there's overall a lot more support. So it's not very actually time. The second consideration that I think is important in payments that has probably emerged in the last 10 years is geopolitics, right? We are becoming a more fragmented world. So if you look at CBDC, so we looked at the introduction of the digital euro probabilistically, looking at speeches, etc. And as the probability goes up, what we find is if you look at US payment firms, their stock price takes a beating. European payment firm stock price goes up. Why? The digital euro is being crafted in a way to benefit their local firms. This is a function of the geopolitics of today, that everyone wants strategic autonomy. And so I think if you look at financial innovation, this is going to be a big force sort of going forward, particularly there.
Great, thanks for that. Let me take some questions. I'm going to start there.
So this question, I guess, is more for Manju. So from my own work in Brazil on open banking and PIX, there are two things that seem to be emerging as very important for this to work really well. One of it is strategic communication. Because I own the information, I decide what to disclose. And it goes to the extent that banks say, yeah, I see this information, but it turns out it's all adverse selection, even though it's I just disclose. And the other one is about firms versus individuals. Firms are kind of quite complicated. Who owns the information? Who has the legal right to share it? And how did India come up with a solution for those things?
Yeah, and so in terms of information, I think India is pretty unique. The consumer owns the data. So you don't have this issue, right? Because the consumer owns the data. You don't give me a loan, that's fine. I can try to tell other people, right? And
No, but for firms, so imagine I'm a corporate.
I'm sorry.
For a firm,
Yeah.
I'm a corporate. So who has the legal right to sign off?
So our studies on consumers, right? So it's, so at least for retail consumers and then the sort of like small scale entrepreneurs, they sort of own the data. For retail, for SMEs and retail firms, I think this is an important question that needs to be studied. We're hoping to study it going forward, but I don't have answers.
Great. I'll come here. Yes.
Yeah, two questions again on this sort of cross-border challenge. One is that I think the United States, one of the objections to a CBDC is that people are like, I don't want the government to have my information at all. No. And it's so different, in Europe and other places. And so be curious about any of your perceptions of that across Africa and other places around the world. And then the other part is that you have done some work with Mexico. And for them, one of the biggest costs in remittances, US, Mexico, is the US is so afraid that the drug dealer is going to be transferring money that they are creating huge cost barriers for the little guys. And it doesn't sound like that's necessarily the case in other countries. So just curious about your experiences. Are there any countries where it's anywhere that bad? Do they have challenges like that? And how do they get over them?
Luke, I think this one's all you.
It's not in there.
Sorry.
So with data, in a lot of African countries, you almost don't have a choice. And saying I don't want the government to have my data. But one of the reasons why folks might not want to be part of the official channel is because they can get taxed. So there's a lot of informal trade going on, and people want to be off book because of that. The other is that there is, you might have heard about hawalas, where there's a huge amount of money that moves outside the system that if someone could just figure out how to get that on the system, there's a lot of benefit there. And hawalas are almost no cost, and it works. So I think sometimes it's maybe what additional value are you adding as a government? If you can just add cost, that's not very helpful. One of the things that we've run some experiments, some in the insurance space with MTN in Rwanda, and people are happy to put aside money for health insurance if it's not, it doesn't look like it's coming out of their pot. So if it's part of the transaction in some way, then it becomes possible. If it's structured in such a way that the premiums are spread out, so you don't really feel the pinch. We've also done a lot with trying to build products for SMEs, and if you charge, if they don't see how they're going to make money from it, then it's almost a non-starter. So you want to figure out how you're adding value versus taking away from them. Yeah, so some of that.
Great. I'm gonna try and take a few more questions, just because there's lots of hands.
Can I just say a word
Uh,
about compliance? 'Cause
yeah.
I think this is like super current and topical, which is that I think that the old regime, not perfect, but not awful in the sense that there was like intelligent risk rating. I think there was an assumption of good faith behavior on the part of the regulator. And there were some pretty significant carve outs of loopholes. Like for humanitarian work, for example, there's a very different standard of care in terms of making sure that money doesn't go to terrorists and so forth, that applies to humanitarian work. And we're now entering this regime where I don't know what to expect of the regulator. And like what the lawyers say to me is that if regulators were to significantly change these sort of standards or behavior relative to what they've done in the past, that alone would be sort of legal defense. I don't know how comfortable I should feel about that as the grounds for my legal defense. So I think that's a big question. Yeah.
All right,
I'll go here.
Sorry, just a very quick one, which is you were talking about wanting to forecast FX and so on. One of the benefits of the Vala transaction system is that it involves a lot of netting. I'm wondering why you can't do netting inside remittances, because that sounds like something you can borrow from the informal system.
Yeah, I mean, everyone, you want to do netting. You've got to balance flows to be able to do netting properly. But also a lot of companies, a lot of governments, so to speak, are prohibiting netting, and that's almost spreading. So you can do that in Nigeria, you cannot do that in Ghana. You have to bring dollars in. And a lot of this is to control for, again, the FX and to have control over their own currency and so on. But netting is great when you can do it.
absolutely. All right, let me take one right there.
Like some conversation today about the absence of that function.
Can you speak up a little? Sorry, can you speak up a little?
There's this narrative that systems like UPI have been helpful in reducing black money and corruption. Is there any evidence of that? Do you have thoughts?
And sorry, the question is.
Is there a UPI reduced black money or corruption? There's a narrative, but do you have any evidence on that?
Logically,
It would make sense if everything is digitized. I don't have evidence on
Yeah,
that.
I think the closest is like Paul's work.
Yeah.
Right, on Aadhaar in the social security and the social safety net, right? Reducing corruption and you guys showing that.
Yeah.
It's not quite UPI,
It's,
but
it's very last,
related. I could
it's very
only-
last mile as opposed to the
Yeah.
back architecture.
Yeah, exactly.
But that's obviously the sort of thing that UPI is meant to enable. Right?
correct, yeah. Okay, let me try on this side, all right. Sorry, I'm trying to like spread out the questions so I catch at least some from everyone.
One question or two short questions. Actually, this is a good example of research that is very useful. It's linking to the previous ones. But my question is, have you find any relation between the outcomes and the results with the market structure? So meaning, there is a potential market lack of competition or associated with the digital payments and new partners, etc. So how do you see that this is affecting the market? And my second one is if the analysis on the credit expansion associated with digital payments may have any bias in terms of a typology of segments that we have analyzed or a period of time that you have analyzed, because there is also some sort of different results depending on what part of the world we actually do the analysis, we get different results.
Let me say one piece and then, I think this is going to be different countries comparison rather than really within country. M-Pesa is a closed set of rails. They built an API. It's the most dysfunctional API around in that it says on their website, you need to come talk to us to use our API. And I was like, no, the point of an API is not to come talk to you. Use it without talking to you. If I can negotiate with you every time, that sort of makes the API defunct. So much as they built rails, I think one of the pieces of that is not opening the rails to everybody. He can talk more about this at infinitum. I'm sure Luke can. So that's a very monopolistic system where if you don't open up the rails, you don't actually benefit the innovation side as much. I think the nice thing about UPI is it's totally open rails. It's the complete other end of the spectrum.
Right. You have Google Pay and one that has a pretty big market share.
On the rails, but at least the fintechs can all come in and compete.
Yeah.
Right. So that's what it's creating. It's creating open rails so that I'm not thinking about the rails competing with each other. I haven't gone that far yet. I was thinking of just the trains compete with each other first. So I think they've got lots. I don't know if you can see this in your data, Manju, is how many unique fintechs there are sort of providing products.
I think we can potentially, and there are lots, right? Because it can be both small as well as large. So the great thing is you have open rail, so anyone can come in. You can be Google and be big, and you can be a tiny one, and that's okay. And you can all sort of transmit data to each other. So one more piece, because my presentation was short, so I couldn't get to, but right, what else do you need? You need to have good and cheap internet connectivity, right? Because without that, none of this works. And so in India, you can see that because internet connectivity was there, but it became cheap once Jio came in, right? And so Jio, which is by Reliance, Mukesh Ambani's baby, right? They built lots and lots and lots of 4G towers, and that sort of covered the whole of India. And so we can see that complements that, where does UPI work better? It's where you have this cheap internet access, right? Which is just allowing, in the spirit of what you said, a lot more competition.
Great. I'll go in the middle again. Sean, do you want to?
Yeah,
I think that's going to be almost the last one.
thanks so much. This has been a super interesting panel. I wanted to connect back to the interoperability point and also the political economy, but a different aspect of political economy, which is Paul mentioned reasons that Visa, MasterCard, big banks would not want interoperability. In contexts where you do have interoperability, there can also be a political economy around pricing regulation. And so, for example, in India, where we've seen this huge effect, in Brazil, where we've seen huge adoption of PIX, the central bank regulated that there would be zero fees for P2P transfers, and that seems to be a large factor in the adoption. In some other contexts, the regulator doesn't have the political ability to do that or the political capital. So, for example, in the Philippines, where I'm working with the central bank on optimal regulation of pricing in an interoperable payment system, they don't regulate pricing currently, but they're considering and have proposed regulations. So the issue that you have there is that what the equilibrium they're stuck in is that the banks charge zero for on-net transactions. So if you and I have an account at the same bank, they charge zero. Then they charge a quite high fee, up to about $1 per transaction, which is very high for these small transactions, for an off-network transaction if you and I have different banks. And we talked to the bank executives there, and they've told us directly that the reason they do this is to essentially build a competitive moat. So imagine you're a bank with a large market share. On the one hand, you don't want to charge a high fee because maybe some of your customers leave. But on the other hand, if new people are opening bank accounts to participate in this interoperable payment system and you have a large market share, you want to charge a high fee for off-net because then when I open a new bank account, I'm going to internalize, well, many of my family and friends already have a bank account at that bank with the high off-net fee. I don't want them to have to pay a high fee when they send me money. So how do you think about, first of all, the role of this kind of zero pricing regulation? How important was that in places like India and Brazil? And then what can we do in places where the political economy is not there to force that zero pricing?
No, I think the zero fees is absolutely critical, right? That's what gives it a level playing field and lets the little guy sort of compete against the big guy. Otherwise, you are likely to have those kind of dynamics. On the political economy, like whenever I present this paper in sort of a regulatory other kind of forum, they always ask me, why don't we have it in the US? Well, we don't even have a dialogue, right, at the top level. So the interest is not there. And we can ascribe it to whatever reasons you want. But this kind of thing, right, with the massive infrastructure, it really does have to sort of come from the top. Otherwise, it's not going to happen. And if the private sector does it, well, then you have all of, like in China, the private sector has done it and it's big, but it's almost a monopoly. So you don't have competition. If there's a shock, you're in trouble. If they don't want to give you credit, you're in trouble. So you have all those other issues.
All right, I think that's a good place to stop. I think right on time. Let me just thank all the panelists for being here today. Thank you guys for thinking this up. And hopefully conversations continue over breaks. Thank you all.
So we're going to